Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss diversifying more than just your portfolio and letting winners win and cutting losers quick.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello? 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us. Pennies.
Going in Raw.
Featuring Dan, Deity Dips,
And Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Sunday, February the 20th, and we're still getting the wonky action on SPY. Not much to really say about it. I forgot exactly the levels you gave, but it's looking like they are approaching the bottom. I can't remember if you said 435 or 430, but it's at 432 right now as we record this on around noon on Friday. Does that affect how you think SPY is going to play out at all? Or do you think we are this is just another going into the weekend, we're going to have a sell-off?
Yeah, that's what we've been following. And obviously, the Russian tensions don't help. And I mean, I'm still pretty bullish on the overall market, but of course the market doesn't care what I think. So I'm still pretty bullish, but I do think that most of this is creating liquidity for the market to go higher. Of course, we don't know, though, how long that'll take to go higher. But I think inside the last podcast or the podcast before, I had mentioned that I was going to buy far out SPY calls, and I did. And as we're recording this, they're currently down 58%. Inside the past 10 trading days, the market has gone from 458 down to 432. And I mean, that's crazy. And you take the last 5 days, and the market's gone from 451.60 to 432. If you guys got your phones in front of you, look at the weekly chart. The weekly chart is something crazy. If you're looking at the weekly chart, that's a massive red candle. SPY hit that 479.98, and then it's been straight down to 440, and then the next week it hit 425. Then we had 2 weeks where SPY's range was 440 to 455. Then this past week, we opened up above 445, and it's been straight down.
So your calls were never even like green at all, ever. You never even had a chance to really scale out of them.
No. But I'm doing this more for the vibes. I'm not really holding them. I mean, like I said, I was putting about 1% of my account in there, and I'm going to hold them. They still have time because I am overall bullish on the market. If the market does rally hard, these will go. These will go. Ideally, we don't see 350 first, though, but these will go if the market rallies. As we just even mentioned inside the last few minutes, that I think that all this volatility is just creating liquidity to bring it higher and a move back up. Now, the difficult part with that is obviously the timing. There's a few people that can time the market, but I sure as hell can't. And so the way that I like to do it is that I don't take options that often. It's more about day trading currently with this volatility, even though I'm overall bullish. So I'll see where the market's at, and then I'll short Piton, if the market starts to flush, or Ford or something that I personally know really well. Personally, I found that Piton works really well for me, but that's a strategy where, during high volatility times where you can't really swing, this is when you can trade stocks and, can trade them every day and not carry over any risk. Just because Piton works well for me, though, doesn't mean that it'll work well for someone else. And the same thing like if Ford works great for you, then it might not work great for me. But this is the time inside the market with all this volatility where those stocks that you trade inside the market, that you trade really well inside high volatility, that you can make really great money. And I don't like to do options. I like to stick to commons. I don't like the decay. And overall, I like to understand my risk. Now, obviously, with options, you understand your risk, but I like to grab 1,000 shares, and I like to know that if it goes up $4 and I own 1,000 shares, I want to know that I'll be down $4,000. I like to know my risk up front. That's just me personally. I'm super simple. If you're not that simple and you like options and you like to leverage, that's totally great and that's totally fun. My point to all this is that I think that we're going to stay inside high volatility like this for a pretty long time. And I think that it would be good to find that side, I'll call it your side piece that, when a Russian headline comes out that, you can go right to and short. And I know some guys who trade just volatility and just trade VIX and they do really well. I personally don't, but it's one of those things where like I said, inside those high volatility times, you date and you find your misses. You find the one that's right for you. And then when you do find that, when you find that one, it's okay to go bigger, on those strategies, especially if, if volatility stays and you start to get really used to the personality of that stock, it's okay to go bigger. Like for instance, Piton, inside the 30s, I don't see it being up here for long, but it's a $30 stock. So I'm okay.
And once you're comfortable with your girlfriend, you need to have a side piece. And so you can trade more than one stock.
Yeah, exactly. Once you get comfortable, mom's not going to like that. The curse and all that. Yeah, she's not going to like that. Sorry, mom.
Yeah, it's a metaphor, though.
I'm kidding. But anyway, when you find that one that works well for you, or the two or three, I don't think that you want to, I don't think that you want to use crazy size on all three because you don't want to over leverage and use crazy size. But it's one of those things where, and I'm just going to explain it the way that I do it. Piton moves a lot on news articles and stuff like that. Even recently, this past week, it was up on a news article about the management team. Yeah, and off that article, it was up like $2 or $3 a share. And SPY was down. So once it that's one of those stocks where once it fails and it exhausts out and shows that it's not going to go higher, that's one of those times that you can scale in and make a hell of a lot. When SPY's green and Piton's red, that's another time where you can scoop it to the upside because it usually follows SPY. And you can do that with a lot of different stocks. I think it just comes down to finding the personality and trading a few that you like. And that's the way that I would do it personally. And like Piton, if you have a $20,000, $30,000 account, I'm okay with you taking 200-300 shares. I'm fine with that. You don't want to go nuts with it, but I'm okay with you taking $5-6 grand of the $20,000 account because 200-300 shares can, $2 down. And with the moves that we've been seeing in SPY, that's not crazy to see that. How SPY goes down $10. So I'm okay with you taking, 200 to 300 shares on that kind of account, as long as your risk is, is in check. Because if you get a $2-3 move, then, that's a lot of money. You make $1,000, that could be your week sometimes, especially if you've been struggling trading and you're just trying to get that confidence back. Yeah, make that $1,000 and make that 2 to 3% and call it a day. And that's what I like to do. And, we talk a lot about keeping the lights on, and that's a strategy that you can use inside these volatile times to keep the lights on. And you guys know that I'm a super traditional guy, but, I enjoy the fundamentals of companies and looking into them. But inside this market with this volatility, if SPY or the market or QQQ fail that key level, I'm there. And they're given really opportunities recently. The big thing is keeping the risk tight and make sure the opportunity is really an opportunity. And what I mean by that is that if SPY breaks below the key level, let's call it 435, and you're like, oh, here we go, time to scale in to Piton, half my account. If you do that, I'm gonna kill you. I'm gonna be really pissed, and I don't get pissed often. So if you do that, I'm gonna be really pissed. You want it to fail the key level, come back, test the key level, and then fail it again. And if you don't get it right in at 435 and you miss out on, a few cents, you can come in my DMs and be mad at me. The thing that will kill your account during volatility is not waiting for a real move. 435 is the key level, and it comes and touches 435. You better, and you scale short, you're going to kill your account, because then what it does, it swipes up against you. And so then what do? You average down. And then now you have 40% or 50% of your account in there because you're just using that key level. And then it swipes up against you and you're down huge. And like we just talked about in the last episode, things have been really crazy. They've been screwing both sides like we just talked about last episode, and that's what we've been seeing a lot of. And so you need to wait for confirmation of an actual opportunity. And then it becomes, fails 435, comes back up, tests it, fails again. That's when you can scale in and you can short. And then your risk is just that 435. Keep it real simple. If you're right away, hell, you can put your stop for a cent gain, right above your break-even average. That's fine. And then you're not going red. There's no way to go red. But like I said, make sure that the opportunity is an actual opportunity and you're not just getting too excited. Like I know that right now there's tons of volatility and volatility is fantastic. But the bad thing about volatility is that if we're just around waiting for a trade, then the second that you see an opportunity, you go crazy, you get all excited and the hormones start going and then it starts swiping against you. And now you're down 4 or 5% on your account.
All right. Well, going into the next thing, and we've gone over it before, but I think it's good to go over it in different types of markets, and especially a choppy one is cutting losers quick and letting winners run. But I think to toss another one in there, because it is a shaky kind of market, is not letting your winners turn into losers. I think that's just as important as cutting your losers quick and letting your winners run. So not too many winners to let run unless it may be like a SPY call or, maybe a put or whatever it may be. Just because there's not too many stocks just going like these 20, 30, 40%, but you still don't want to let them go out too quick. Which one do you kind of want to start out with? Cutting losers quick, letting winners run, or not letting your winners turn to losers?
Not letting your winners turn to losers, because I feel like that's kind of what we just talked about volatility. But it's really important in all aspects of trading. I know that that's super difficult. And for me, it's not necessarily about the money that I lose. It's about, that I'm up $200 and then it goes, and then all of a sudden I'm down 100. It's not the $100. It's the fact that I was up 200 that makes me the most angry. And especially in swing trading, that's super difficult. You got to be able to control your emotions. And for day traders, that's why I'm not a big day trader. And a huge momentum trader is because that would make me fucking livid. That would make me so mad. If I had I know a lot of day traders like to use their, they trade most of their account daily. So if it's like one of those things where
I'm talking like 4 or 5 times on the good days.
Yeah, exactly. Yeah. But that's the thing though. If I was up like 5, 6, 7%, if I was up and then, if I was up 5, 6% and then it goes against me and all of a sudden, I'm down 6, 7%. By the end of the day, oh my God, I would be livid. I would be so mad with myself. So that's the reason I can't do that. I like their strategies to day trade, but I just know myself, I just know that would be an issue. Like I wouldn't sleep the next night. And then for all intensive purposes, for anybody that lives on the East Coast, that would be a terrible thing because I wouldn't be able to handle it. I would be such a bitch. So that's the reason I don't really do that. The reason that's obviously important to not let winners go into losers is because that's how it's not the fact of money, losing money. It's the psychology part. One of the things about our minds is that they play tricks on us. And so we talk about it frequently, but I think it's really important to bring up now is that when we have green and we're on a winner, I'm going to talk strictly for swing traders right now, or from like my experience, and for day traders, but not scalp traders. The scalp traders, it doesn't really account for you. When we're up, let's say $50, or 1%, nobody wants to take that. But when we get up 5%, everybody's like, oh, I got to sell here. Even if that it's going to go higher, like 20% higher. Instead of, leaving some, we just want to take the little bit of green. even if we know. It's kind of like that balancing act of like, if I see a penny on the ground, I won't pick it up. But if I see a nickel 500 feet away, I'm sprinting to it. You know what I mean? Even though I know that if I go a little bit further, another 500 feet, there's potential for $1.
It's like me with blue chips versus me with a like low float penny stock.
Yeah. So the thing is that, like I was saying, is that it's a real big balancing act. But what ends up happening to our psychology is that you had the first opportunity to take green, and then you felt like it was too small. And then you had the second opportunity to take green, and maybe you took it. But then if you don't take that green and it starts to go against you, that's one of those times where you can lose a good amount of your account. And we all know sometimes, like when you're in a position, that you're just going to get smoked on this, but you're just praying that it bounces back. But to a stock that's super strong, that is going to go higher, but you just want to lock in the profits, you don't take that off the table. So what I'm saying is that if stock A, inside your heart that you're just praying to get out, you're just averaging down, but you just keep adding to it. But stock B, it has so much room to run. And every time that tests key support, it bounces off of it beautifully and stuff like that. You'll take that profit and you won't add to that on support. But stock A, though, when you're down a hell of a lot, you'll just keep adding to it, averaging down, because you don't want to take the loss. And that's where it gets really dangerous. Going from a winner to letting the winner turn red.
It's called the sunken cost fallacy, bud.
Really?
Yeah, there's a word for it.
That's pretty good.
Yeah, it's the sunk cost fallacy means that we are making decisions that, we are focused on our past investments. It's like when you watch a movie, you're 30 minutes in, the movie sucks, and you just but you're like, oh, fuck it, I'm already this far in. I might as well just keep watching it.
I might as well just do it.
Yeah, no, that's what happened to me with the movie, The Colony on Netflix, and it's awful. It's terrible. But no, I think like the worst part, by not letting your winners turn to losers, I think scaling out is a really important part of it in all senses. But also, your winners can turn to losers, but also they can turn into just account destroyers if you're doing what he's saying and just adding on these dips. And like, yeah, you were up 20% on it. Now you're down. So you're like, okay, it was at 15. I was in at 12. Now it's back at 12. Finally, my dip's here. Then you're at 10. Okay, well, damn. Okay, now I can't wait for it to be back at 15. Like, and then you find yourself in a hole, and that's worse than turning a winner to a loser. That's turning a winner to something that you'd be more down on than had you not fucking got in it at all. You're treating it like a loser, and it wasn't even a winner in the first place. So as long as if something's a winner, let it be a winner. And I really like what you were saying earlier, like with the 1 cent above it. And that's what we were talking about last week with the trailing stop loss. That's one guaranteed way not to turn a winner to a loser.
Yeah, no, exactly. And so, yeah, and the trailing stop loss is great. And that's why, like, if something starts to work for you, and I don't want anyone to get confused, like I'm all for taking profits, like you should. But the difference is that I want you to layer in the profit on a winner. So when something breaks through a key level and, it has a really big green candle, take some off there. And then when it comes back down to support and it bounces off, re-dip by it. So then it's like a whole bunch of new positions. And at the same time, you're layering profit. And that's the way to do it. Don't be done with the stock. Be done with the stock that, with the one that, isn't going to do anything. But the same way that you average down, you average into a loser, average up into a winner. So again, support, add, sell. And if it comes back down to support, fine. Or if it breaks through that resistance, sell a little bit more. And then if it comes back down to support, add there again. If the stock's resistance is 12 and you want to come back down to 10, and that 12 now becomes the new resistance, that's okay to add that support. It just comes down to, that's a new play. And so you got to manage your risk the same. So you're building up profits. And so ideally it stair steps all the way up. That's the obviously ideally. But even if it doesn't, and you build that profit and do it until it doesn't work, that's the only advice I got.
So on the contrary, where you have cutting losers quick, when people say dip buy, dip buy, dip buy, is it just a term? I mean, is it just a sense of depending on what market you're in, or is there just like in this market, cut them all quick if they're not working, as opposed to other markets where it's, the DDs, the fundamentals are there. I'm adding on dips. But I mean, there are times where the fundamentals are there, but you look back and you're like, damn, I should have cut this months ago.
That's when the new risk management comes in. You need to make sure that you're picking your spots well. That's what most of this comes down to, is picking your spots well, really well. So it's going to be about like, hey, if this thing gets through 12 and it goes all the way to 20, great. But if this thing gets through 12 and it hits 13 and then it comes back down to 12 and it tests 12 maybe twice and then it bounces off, I'm going to rebuy it there and then I'm going to hold it there for the 14. So when I say like hold it, I don't mean cut the entire piece and position. I mean cut 50%, because what ends up happening is that, let's just say that 10 is the first cut spot, and then you cut it and you cut it when it breaks 10, and then it comes back down to 10, and then test 10 once, test it twice, and then a third time it breaks down. You still have that. You already locked half. You already locked half those gains. So me personally, I like to be a little bit more lenient with my positions. So what I'll do is I'll say, okay, let me see what it does against 10 again. And so if it comes up against 10 again, and then maybe I'll sell some there if it, when it gets back up there. And then if it breaks down from there, then I'll cut it off. So you understand that, you're missing out on some profit, but the potential reward, if this thing stair steps all the way up, is huge. Let's look at it. If you cut some at 10 and then goes to 11, comes back down, test 10, and then you add back, and then it goes to 12, and then you cut some there. Now you just doubled your profit, if you cut some there. So then maybe you're giving up 20% of the profit on the downside. So instead of $100, you make 80. But if it does continue to run, then you're going to double your profit. You're just going to keep rinsing and recycling. So yeah.
And I think it also goes back to position sizes. I mean, if your starting position size is not drastic, that first add on the dip is not going to be nearly as scary. Even you're not gonna be like, oh, okay, it won't feel like you're gonna have to cut your loser as quick because the first dip really didn't affect much.
Exactly. And again, even if you rode this thing all the way back down, let's just say you bought it at 5 and you rode it all the way back down to 5, it's really like you sold it at 7.5. And so that's like, to break even. Now, if you ride it back down to 7.5, that's fine. It's still like you still have tons of profit, if you sell at 7.5. So I know that like everyone wants to, I saw that I was up $130. I don't want to sell unless it's for $130, like that max profit.
Yeah, no. And we talked about like a long time ago in the Adeline episode, it's, when you see that number and then you try and get back to that number is where you really start, screwing yourself over. You got to accept the win and that's that. And lastly is letting your winners run. Kind of tough in this market, but at the same time, I think it goes back to one thing you used to always say is I'd rather get off the bus stop 1 stop too late than 5 stops too early, meaning you'd rather the stock hit its peak and then dip a little bit and then know it's time to get out as opposed to get out way before it's at its peak. Do you kind of want to touch on some strategy on how to do that?
Easy dork.
No, you remember, obviously you probably do not remember this, with the bus stop 1 stop too late as opposed to 5 stops too early, which means you'd rather
I know my knowledge means you dork.
After it's dipped you've messed it up a few times. I just want to make sure.
2 things I'll answer this with, because one of them is going to contradict what I basically just said, because we do have those parabolic days where if things just go absolutely nuts, let's just say you're in something and it goes 300% and you're like, hey, this is all-time highs. Yeah, you can use Fibonacci's and you could use like time of day, 230 dip buy, a bunch of different shit. But what I personally like to do is that if you're up, some crazy amount and this is past like the plan. So when you're creating the plan, you might say that, I'm going to stair step this all the way up to 15 from like 7.
Like you said, hey, we're going to Canada, and you find yourself a little bit closer to Greenland, and like you're like, fuck it, I might as well stay on until I'm at the North Pole. Yeah.
And the one thing that I'll say is that sometimes you just got to be happy with profit. And listen, like, especially if you're a swing trader and, you sell 75%, there's some of those days where stuff just goes 300% and it's through all-time highs. Like, I don't know what to tell you. You can use Fibonacci's, you can wait for it to find support, but there's some days where it might go up 300% and it might end the day it might only end up the day up 150%. And so scale out along the way on those parabolic moves, sell 10% every 20%. That's another way to do that too. And then wait for it to fail, like the same way, or ideally, we've all ideally shorted stuff or are learning about shorting. And so when you see that exhaustion move, same thing like shorts look for that exhaustion move to short, you can look for that exhaustion move to sell. And that's one of the biggest things. People will just hold stuff. They'll just hold it all the way up and all the way down. And then, listen, sometimes you just got to be happy with profit. And that's totally okay.
All right. Well, our very last segment is diversifying outside of your portfolio, basically meaning anything other than stocks. But before we do that, I would like to get you, big power ranking guy. I think we should do more power ranking as we go on. Power rank these investments: REITs,
okay,
apartments, stocks. You may well write these down. You ready?
Yeah. Okay. All right. Hang on a minute. The list was getting real long.
REITs, apartments, land, crypto, NFTs, stocks, Airbnb.
Isn't that the same thing as apartments?
No, we'll just do
like truthfully. You want me to talk about like Airbnbs?
We'll do rented, like renting out
overshot rentals. All right, so just rentals overall.
Yeah. No apartments, no house renting out, no duplex, just rentals.
Okay, so first off, I think that if you have enough money, all of these are great. They're fine. Now, I heard a quote once, and honestly, I might have made this up, but I heard this quote once, and it said, "People get rich, and their families get wealthy off real estate." And so I'm totally messing that up. But what I'm trying to say is that once you have some money, real estate is the most viable option to keep it, and 2, to cash flow it. And why I say that is because if you take $5 million and you put 20% down, let's just say that that you're not completely vacant all the time, you're going to be able to cash flow that. So, and you can borrow like 20 million on that 5 million, so 20 million gets you a lot of apartments. Unless you're from New York, then you get like a 2-bedroom, but everywhere else, you're going to get a bunch of apartments, and then they can cash flow, and you'll have them for years and years and years, with very little risk. And of course, you have the housing market, the housing market crashes, of course, and if vacancy rate becomes extremely high and you can't pay your mortgage, and there's so many different things, but that's where like your own risk appetite comes into it. So that would be like the first thing. Now, I'm going to do the power ranking from best to least. And this is all my personal opinion. So the first thing is obviously the stock market. Now, I don't necessarily believe that people should be individual stock pickers. Like, I don't believe in that at all. Like, I don't personally just invest in different companies, except for the 5 companies that everybody inside the world knows. So that's me personally. So I don't believe in individual stock pickers for the future because so much can happen. What I do believe in is target date funds. And I believe inside the S&P 500 and the other trading indexes that we have, the market has never not gone higher. This means that even if you take $100 bill right now, or even even with the market up 100%, or even if you could have been the person to bought the absolute all-time high on the S&P 500. What was that? Like 4,700 or 4,759 or something. And if you took that $100, the market is saying that historically, even though you're down right now, $12, $15 or $12, whatever, that historically that investment will be green at some point. Okay. So how many other investments can you truly say with guarantee thus far that in all of its history, you will 100% get some return back if you just wait long enough?
That's what they said about the housing market in 2007.
No. There's so many things about the housing market bubble that happen that are so interesting and wonky. And the amount of case studies in the house market is so interesting. That could be its own episode. But anyway, I'm a stock guy. So number 1 is going to be the stock market. Number 2 is going to be the apartments. Kind of what I talked about earlier about the rentals. Once you get a little bit of money, and even if you don't have crazy money, the apartments now again, this comes down to your at-risk appetite, but apartments are a great way to cash flow. And if you learn enough about it, similar to the stock market, now the stock market's a little hands-off than this.
You're gonna be surprised at how little how much $4,000 gets you for an apartment outside of where you live.
Yeah,
it's awesome.
Yeah,
I've got this is 3,100, I think, 1,500 square feet.
What?
2-bedroom, 2.5 bath. Yeah. I'm in this is my computer room, Mitch.
Yeah, you know what? So put in perspective. Dan's in Houston, in the nicest building in Houston, right? Like one of the nicest buildings?
No, yeah, it is.
Arguably?
Yes.
Okay.
We don't have to argue.
Dan has a balcony and 1,500 square feet and no state income tax and a balcony. And he pays $3,100. I have a roommate. Love him. Great guy. A roommate. We share an office, and then I have a bedroom, and I pay $2,700 a month, and we share the 1,500 square feet, and I don't have a balcony, and my building doesn't have a poker room, and Dan's does, or a basketball gym.
Yeah,
I don't have a basketball gym.
You have at least 2 pools there, right?
I don't have a pool.
Tanning bed?
I don't even have 1 pool.
Steam room?
No steam room.
Sauna?
No.
Movie theater at least.
No movie theater.
Arcade?
No.
Okay. All right. This is crazy. You need to move. You need to get out of there, dude.
And I also pay state income tax. So that's good.
Yeah, that can't be. That's not happening.
So what I'm trying to say is, besides that I pay a lot of money inside the Northeast. What I'm trying to say is that if you take the time to learn and invest, and you take the time to invest in an education and to learn about real estate, which tons of people do. I don't really feel like it's rocket science. I personally am not the most educated person, but you can find really good deals similar to the market, how you pick swings and stuff like that, to where, your appreciation can be super high and you get cash flow. You know what I mean? And so, I'm a
TikTok real estate investors.
Yeah, exactly. So I like apartments and stuff too. Now, number 3, REITs are kind of one of those things where, if you're just looking to diversify, if you have a pretty decent net worth and you're looking for a little bit of cash flow and you're looking to diversify a little bit, this feels like a really good option. Or substitute number 2, the apartments. You want to take that money and put into a REIT. I think that's totally fine too. It's less risky. Oh, I shouldn't say that. It's less risky from a standpoint of if there's no vacancy and stuff like that, then you'll blow up. But what I mean by less risky is, you're leaving it to people who you think are professionals or people with knowledge. And on top of that, REITs are usually so big and they're so diversified across the board.
So are REITs your third? Are you putting those third?
Well, it's like a third, but it can be the second. You can substitute.
Are you putting it above land? I think is the big question.
Putting it above land.
Woo.
I am putting it above land.
Okay.
And like I was saying about REITs,
My parents are
I
gonna
like
hate
REITs.
this.
Listen,
We've got a lot of land.
listen. I personally have land. Like I have,
My-
handicap.
My
owns
family
land.
has much more land. My family
sure.
are land owners, bud. Alabama, Stockton, Alabama, dude, that's mine. When they're gone,
That's a
dude,
gold mine?
it's mine.
Oh, it's,
Dan is
it's your
mine.
okay. Yeah.
Yeah.
So listen, I like land. Now, some of this has to do with where I live. Again, it has to do with where I live because I'm from the Northeast. So land is, really, really expensive. One of the only ways to do, land or to acquire land or, I don't want to call it for cheap, but to get it for a good price is if you do it through an auction. But most of those times, those auctions, they don't even have roads, so you're just, you're just buying forest.
Well, yeah, that's what land is, dude.
No, but I mean, like, I want to buy like plots.
All right, dude, you're going to spend a little more than that.
That I can just sit on it. I don't want to buy a tree. But yeah, so what I'm saying is, like me personally, it's so much through the auctions and stuff like up here. And like I said, land in and of itself is still 50, 60 grand for like half an acre up here.
Oh, dude, it's like $5,000 an acre, and like where my parents have it. Yeah.
I was talking to a trader in Vegas and who, I was talking to him and we were talking about like, he lives in Detroit. And we were talking about the land grab in Detroit. And I was like, dude, I just kind of want to buy like a few plots of land inside Detroit just to,
why not?
Just in case, yeah, exactly. Why not? Because you can get plots of land for like $1,000. Maybe not that cheap, but
there's those things where it's like the $1 houses or whatever. I'm not sure how they work, but
oh yeah, I love those videos. So what I'm trying to say is that I think most of it depends on your personal risk appetite. And again, being inside the Northeast, it doesn't really make that much sense for me to buy land, when I'm buying it for like 50, 60 grand and they don't have water, they don't have electric, they don't have roads.
You don't have electricity because there's nothing there. It's trees.
Yeah. I know. I was about to say electricity. So, you buy a few trees inside some forest, but when I can use that, better, I don't see much return on investment for me to sell to like at a 50 grand cost. Or hell, if I'm going to put a neighborhood in there, I mean, that's going to cost me a hell of a lot of money. So me personally,
dude, no one's buying fucking land in New York, bro. You got to buy it somewhere they're eventually going to develop, like Atmore, Alabama. And guess what, dude? I know a lot of land that you can buy for cheap. I know I said 5,000 earlier, but it may be 15,000 depending on who you're buying it from, and I'll sell it to you for a great price, dude. So next you have it's all trees. You're not gonna like it, but down there, I mean, that's what most of Alabama is anyways. So it's kind of like par for the course. Different opinions on land. I'm a big land guy. So now we have NFTs and cryptos. The funny money gang aren't going to like this one. Just kidding. Don't hate me. But yeah, no, we are actually, we were at the prices where you said you'd be interested in buying. Or at least we were for a little bit. So let's finish off with your cryptos and NFTs. I'm sure I know the order they are in. And speaking of NFTs, the NBA All-Star game is this weekend, and the Slam Dunk Contest is obviously there. And Jalen Green is partnered with the NFTs Top Shot for the game. So I have a feeling, A, that he's definitely going to win because they're going to push that agenda. And B, that's the A and B. Yeah, fuck NFTs. Just kidding.
You guys know I am. I'm a traditional value investor guy, and there's not enough history around crypto and NFTs. Now, I understand that if I bought Bitcoin in 2005 and when I was in kindergarten, then I'd be rich. Okay, I understand that. But I had more important things going on, like crayons and like this girl I thought was cute. But anyway, the thing is that I need to see like at least a decade or two of my life, of my adult life, where I personally can experience it and watch it. The market has 10 times more of a history than crypto and NFTs. So therefore, me personally, I don't personally feel comfortable. I need a little bit more history on it. The other thing is that I just see so much risk on it. Nobody won this at when it was at $3,000. No one wanted it. Now all of a sudden everyone's like buying it. Like Tom Brady buying it at like $50,000. You got Venezuela's president making memes about it, about himself, about buying top. Like Venezuela came on the news and enticing people to buy their bonds, buying their bonds by not taxing them. Well, why are they not going to tax them? Because they need people to buy their bonds, because they have nothing. Their economy is crippled. It's crippling. Like if Bitcoin does go down, like let's just say, $10,000, holy shit. Like Venezuela's
China's there. That's China's country.
Yeah, we're just gonna call it China.
Yeah. Chizuela.
Yeah, exactly. And I understand that their economy. I mean, we talked about it, when the article came out, that this felt like a last stand for them, like a Hail Mary, like fuck it. Let's buy out of the money options 50 years down the road.
This is literally like Abraham Lincoln becoming president. Like, you win the Civil War, you save the country, you're one of the best presidents forever. If he loses the Civil War, he's the worst president forever.
Yeah, it's all or nothing.
Yeah,
exactly. It's all or nothing. And that's the shit that scares me. Like, I hate that. So for me personally, I group crypto and NFTs together. I feel better about crypto than NFTs. I like the idea of NFTs, but the thing about cryptos and NFTs, and especially about NFTs, is that they're going to have to regulate it and tax it in some way. Like right now, like the US government, the regulators, they've all come out and say that money laundering is a thing, that they're aware of it.
Same as big art, dude.
Yeah, no, exactly. So the thing is that it's not as accessible. Like, I feel like, as much as I love the government, like, let's be honest, you never go after like a Warren Buffett, but if me and Dan start buying up Picassos and putting them offshore, then, we're going to get a knock. Who's going to get first, me or Buffett? Buffett, probably me. I'm going to get the knock first. So what I'm trying to say about all this is that, one, I see the risk. I see too much risk from like everybody so risk on. And that's usually a pretty big red flag to me. Like, you got like Paris Hilton, and she's like the girl who wasn't even allowed to like drink by herself, right? Or like eat by herself.
That was Britney Spears.
Oh, that was Britney Spears. Well, yeah, either way, I mean,
same thing. Yeah.
You got like celebrities coming out and buying crypto. And then, you got economies, like I said, who are Hail Marying their future and making memes on Twitter. Like, it's no big deal. And so for me, that's kind of like a red flag for me. So from like a regulation standpoint, regulation, something's going to have to happen. They keep talking about it. Now, personally, I don't know when that is or when they do it or how they do it, but they got to do it. And they will do it. I mean, hell, it might take 2 decades. Like, I'm not going to say it's going to happen overnight, but regulation will come. And I think it comes down hard, because it's kind of been the wild, wild west right now. And, it's been, they know it's the wild, wild west. It's like they put like a big strip club in like the middle of this college. It feels like it shouldn't be there. And eventually the school's going to say something about it, but they don't know what to do.
18 and another strip club, and that's not a bad idea, dude.
Yeah, I'm always talking about the business opportunities. So for me, yeah, it just feels like a lot of risk on. I know a lot of people are waiting for me to say this, and so I'm going to say it, but then I want to explain myself. So the other thing is that even at these prices, crypto is still, I'm going to speak and I'm going to talk about the cryptos. Cryptos are still up like so much. They're still up inside the last 5 years, huge. Now, that's not a reason to deter me, but it just adds to that overall thesis that like right now is just not the time, to give more exposure than a few percentage points of my net worth. Now, listen, like I said, I'm exposed to it, like I'm exposed like radiation, baby, but it's no more than 2-3%. Maybe a bad day in the market, it's closer to 5%, but that's the way that I truly like to do it. And that's, and when people ask me, I just say that like, I don't know enough about it. And I try and explain that, I don't think there's enough history for me to feel personally comfortable. And like, I feel like regulation has to come down. And when regulation comes down, I don't know. But like, do I see pictures of apes and frogs going for like 400 grand forever? Probably not. But I do see.
It'll probably be $1 million.
Honestly, probably like 4 million. But like, there was a while there where NFT project that a celebrity tweet out, the thing would go crazy, 200-300 grand. Like who's doing that? And the other thing is that like there's tax scams out there, for NFTs, buying it in one wallet, selling it in another, like Melania Trump. Sorry, I totally messed it up. Sorry, Miss 40 Minutes Lady Trump, whatever. But you got Mrs. Trump who bought her NFT who someone bought her NFT and then it was tracked back to a different account of hers, and people are getting away with taxes by doing that and then writing off the loss. And I'm not saying that she did that, but I'm just saying that's what people are doing.
No, dude, a lot of times what they'll do is they'll just sell them to themselves so they can pump up the price. Like, holy shit, this one was sold for $12 million to a celebrity. Wow, oh my God, she bought it. Then she could resell it for half that,
Yeah.
You're still...
Yeah, no, exactly.
Because if you owned it, bought it from yourself, and then sold it for half price, you made that half price. You're just paying gas fees.
The gas fees, they're a lot. But yeah, me personally, I just think that there's a lot more risk involved. And there's not enough history for me to be like comfortable with it. So I can look at historical data. So like for me,
well, land's been here longer than real estate. So,
but that's just a big pain in the ass that I don't want to deal with. And also like 50 grand for like some piece of wood is like, listen, like I just don't see how the return on investment. Now, again, I have land. So and recently I bought it. So so I'm test driving it. So if someone offers me a few bucks, 10x my investment for my land, I'm going to come right back on this podcast and say that I love land. But me personally, I like to think of things from my perspective. If I wouldn't purchase this land in 5 years for 50 grand, 200 grand, 500 grand, I'm not. So I probably wouldn't do that. So that's the way that like I approach things. But hey, if it happens, I'm gonna come right back on here and say that I love land.
All right, well, we've recorded this about 6 times because Hugh's memory on his PC is messed up. So he's got to go re-record because I recorded properly. We'll see you all on Wednesday. I hope everyone has a great weekend or had a great weekend. And take care. Lands, REITs, cryptos, NFTs, and more.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.